Folks, we're in the middle of a big meltdown. Markets are crashing. Nearly every major name is seeing major sell-offs, and pain is spreading everywhere. And so in today's video, we are going to break down everything that you need to know. This isn't going to be a hypey video. It's not going to be a fear-mongering video. It's going to be a data-backed video. We're going to be breaking down 4 different things. Number 1, what is going on? Number 2, historical data that predicts what's coming next. Number 3, what big money managers are saying about a possible recession coming over the horizon. And number 4, how to position yourself appropriately, a key perspective for everybody that's either been in the market for a while or is new to the market. But as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence before taking any action on any ideas presented. And quick plug, today's video is brought to you by our 100% free email reports. Sign up today and get immediately emailed to you our report on 5 stocks that will help you survive and thrive in this crash. First link down below. You're not going to want to miss these 5 stocks. Okay, so let's go ahead and start. So the market is panicking. Markets keep making lower and lower lows. Lots of hedge funds are getting pummeled so much that they're getting margin called, accelerating the downtrend. And the reason markets are panicking right now is simply because of trade policy. If you go back to Apollo's research on what the biggest risks are to global markets in 2025, well, tariffs were coming in at number 1, with 90% of respondents choosing to pick this as a main risk. And we are in the thick of it at this point. Now, bigger picture, back in November, President Trump wins the election, the market surges. Tariff threats begin. Markets slow down, start to sell off, back and forth bouncing, and then the trade war begins. You get a panic sell-off, a buy the dip momentum, and then a final peak before the tariffs headlines begin. And since then, we've erased some $4 trillion plus in market cap in the last 3 weeks alone. Now, if you look at the multi-asset price trajectory since Trump took office in 2017 versus 2025, you could see the S&P 500 during Trump 1.0 was straight up, and then with 2.0, it went up a bit and then straight down. Same thing with the Russell 2000 small caps, but even more extreme. And if you look at the commentary from Wall Street, many firms are looking at this tariff situation and are thinking it's time to get out as fast as possible. And when asked about this, President Trump said there's a period of transition because what we're doing is very big, Trump said Sunday on the Fox News show Sunday Morning Futures. Trump said there could be a little disruption. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We go by quarters. What we're doing is building a foundation for the future. We're bringing back wealth to America. That's a big thing. It takes a little time, but I think it should be great for us. Asked whether he thinks a recession is imminent, Trump said, "I hate to predict things like that." He later added, "Look, we're going to have disruption, but we're okay with that." So a lot of folks are listening to this and they're rightfully scared. It appears that the Trump administration is forcing a crash to happen, and they're even warning, hey, look, yeah, there's going to be a disruption. Mass scale layoffs from the federal government, big contract cutting, and now a beating of companies and industries who have exposure to our main trading partners. And the bigger picture here, whether you agree with it or not, is that the Trump administration is trying to switch the U.S. economy, which is very heavily reliant on public spending, to now private. And there's a big shock to the system with that. Also, of course, on the other hand, we're also trying to switch the reliance on foreign countries back to our domestic companies. Now listen to this quote from Treasury Secretary Scott Bessent. Quote, "There's going to be a natural adjustment as we move away from public spending to private spending," Bessent said Friday on CNBC. "The market and the economy have just become hooked, and we've become addicted to this government spending, and there's going to be a detox period." Okay, detox period. Do you hear that? Well, that is what's going on in the market right now. What does detox mean? It means money is going to be draining from the economy everywhere from capital markets to job markets. This is what the Trump administration is trying to do in hopes that you can get the U.S. economy on better footing if you drain it of all of the negative artificial pumping that has gone on the last 4, really 8, 10, 15, 20, 30 years. Now, we could hash it out about tariffs and whether they're good or bad or whatever, but who knows how this is all going to play out? Nobody knows. Our goal as traders, investors, market participants is to snap up assets at unbelievable prices. And the fact of the matter is, look, again, no one knows when this uncertainty is going to end or how it will end, but hell, buying the dip in good assets at good prices has always been a way to make unbelievable money. You got to make sure you know what you're buying and you're patient because oof, can that print. Now, bigger picture, what is the whole point of this detox period? Why would you want to do this? Why right now? Well, there's a few big reasons. Number one, the U.S. has approximately $7 trillion of debt maturing soon. We've got a lot more than $7 trillion of debt, but $7 trillion is maturing in the next couple of quarters. Refinancing those trillions of dollars at current high bond yields, Well, that's going to be very, very, very costly. So many people are theorizing here that Trump is aiming for a stock market and overall asset drop because when these assets fall, investors will rush into bonds for safety, and this increased bond demand will drive bond prices up and yields down. Lower yields mean cheaper refinancing costs for U.S. debt. Lower yields also stimulate economic growth, boosting the economy and markets in the long run. And this is actually something that the Treasury Secretary hinted on, saying that they're not focusing on short-term rates, but focusing on long-term rates. Long-term rates are affected by a potential recession, right? And if we do get into a massive recession, well, that's a huge deflationary pressure on many, many assets and goods and services that have ballooned over the last 4 years. And it puts pressure on the Fed to cut short-term borrowing rates as well. And another reason is that Trump's long-term goal has always been for companies to relocate into the U.S. So if there's pain to get to that point, he predicts it'll pay off later and these factories and jobs will relocate into this country. Now, again, it's yet to be seen how all of this will play out, but this appears to be the strategy. And so it's up to you to use your capital to milk this strategy as much as you can and also protect yourself. But bigger picture here for folks that are very, very fearful about these headlines, I do need to give you some perspective. So market corrections tend to happen every 2 years, with bear markets occurring approximately every 6 years, making such downturns common. Every single time there's a big crash, everybody loses their shite, they sell out, they make horrible, financially devastating decisions. But regardless of what is causing a sell-off, whether it's tariffs, COVID, inflation, whatever, well, you got to understand, historically, we get sell-offs regularly in markets, and it has always been healthy and a breath and an opportunity. For folks that want to buy a dip and then they need an immediate recovery, obviously, if it gets to be a bigger dip that keeps dipping, well, that could be a painful experience. But that's why you don't go guns blaring on every dip. You go slowly, dollar cost averaging into your favorite names, playing the moves, but not letting the moves play you, right? The fact of the matter is that market corrections are very, very common. Over the past century, there have been 50 market declines of 10% or more, illustrating the cyclical nature of the stock market. You got to remember, these are normal parts of market behavior. Just like in life, you have ups and downs. Well, the stock market does as well. But the broader market, the S&P 500, has historically provided average annual returns of 8 to 10%. And if you're looking at growth stocks, stocks that are actually attached to businesses that are growing huge, well, even though they could dip huge, like Palantir can dip huge, well, during their bull markets, they go up so much more. So you got to understand, the only way to really, really screw yourself is to say, okay, I'm out of the market every single time the market dips from highs. No, no, no. The goal is to figure out, okay, well, where am I going to put my money to get the biggest possible rebound during the next rebound cycle? You got to be mentally prepared. Hey, I don't know how far this is going to dip. A lot of it has to do with the policies coming out of the Trump administration. I will admit that. I don't have any ability to predict if he's going to go harder on tariffs or less hard, or if he's going to completely pivot or whatever. Who knows? But I got to prepare myself mentally and really emotionally to be able to deal with milking these strategies and milking this kind of market. You got to focus on the bigger picture and look for opportunities. I know it sucks. Many of us have been through so many sell-offs together, but there's always light at the end of the tunnel, and you'll always look back and say, I wish I made the right choices during that last dip. I love this one meme that keeps coming up. It's this guy that's saying, I'm an idiot. Why didn't I buy insert whatever stock here at $540? And then it dips and it's at $390, and the guy's like, LOL, I'm not buying that shit. And then it goes to 1,000, and the guy's like, I'm an idiot. Why didn't I buy? So this is the same story with good assets, good stocks over and over and over again. It's the same damn story, and people will do this over and over and over again. When something is dipping, they'll say, I ain't buying that shit. And then when it's back up, oh, I was an idiot. So folks, please, please, please don't let that be you. Buy good companies at good prices. We're going to bring you all the ones that we could possibly bring you on this channel, but you also got to be doing your own work to make sure that you're building that conviction so that you don't buy the dip and then all of a sudden it dips a little bit more and you're like, okay, well, I guess it was a scam, and then you sell out and then it goes up 3x the next cycle and you lost all your money. Volatility is back big time, so stay cautious, stay nimble, and get ready to exploit. If you'd like our opinion on the top 5 stocks to dip by during this market condition, I'll put a link to ZipTrader's free newsletter down below. First link down below. We'll see you there. Have a good one, folks. We'll see you in the next video.